Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash-flowing properties in today's market. Here's your host, Gabe Peterson.
All right, we are back with another episode of the Real Estate Investing Club. I hope you guys are having a great day, whatever day it is for you and wherever you are. Usually it is Friday on the podcast, but today is Wednesday. We're coming out with those one of those rare Wednesday episodes. It's going to be a good episode for all you guys who are interested in storage. You know, I've talked up that asset class so much on the podcast because I love it. And we got a specialist in the storage field, in the storage asset class, Nick Huber, with us from Bolt Storage. They own quite a few storage facilities, and so I'm sure he has a lot of wisdom to impart to us. So Nick, thanks for hopping on.
Thanks for having me. It'll be mixed bag of good and bad here when we just discuss storage, I think.
That is always the interesting part. I'm sure we both have horror stories, so don't hold back on that part. All right, man. Well, I told you before we got on here, we always like to start with stories. We like to hear how you got to where you are. So why don't you take us to the beginning before you got into real estate? Tell us how you got started, and then how's the trajectory been going since then?
Yeah, went to college in upstate New York at Cornell. Right out of college, started a moving and storage company. So pick up and delivery storage. It was a very difficult business. Learned the ropes about operations. Built that business to about $2 million a year of revenue. A little above that, and a lot of part-time employees during the busy season when the students were moving in and out. 2015, we started our first development project, acquired the land and started construction, opened the doors in early 2017 on a $2.9 million development in upstate New York. That deal went... Storage? Yeah, self-storage, yep. From ground up. It was 39,000 rentable square feet, and then we bought another 12,000 rentable square feet across the street, kind of as part of the same project. That one deal went phenomenally well. It's worth $8 to $10 million today, and we still own it. We've refinanced it a couple times. Took that traction, bought 3 or 4 more buildings leading up to 2020. 2020 got access to some outside capital, and then over the following 3 years raised $40 million of outside capital, bought $100 million worth of storage, and now we operate 63 self-storage facilities, 2 industrial buildings, team of about 50 people across our investment PE side and our management company.
Nice, man. So, it sounds so succinct when you tell such a long story in such a small amount of time, but I know there's been ups and downs.
Yeah.
I'm sure you've bit the bullet with a couple facilities after buying so many.
Yeah.
So let's.
Hey, you want to start with the bad? I mean, I think
no. Let's just start with that development, because it's interesting that you chose development as you didn't buy before you developed. You started developing. Which is not a path that a lot of people take. Why did you guys choose development? And tell us a little bit of context about that.
Yeah, my dad was VP of construction for a developer in Indiana. He didn't have equity in the business, but he was kind of the right-hand man and was a VP of development across 30 nursing homes through Southern Indiana, Ohio. He learned a lot about development. And so he's mentoring me, and we're having a beer one day, and he's like, you guys got to go build one. You don't need to buy one. Build one. And boy, oh boy, did we learn the ropes about how hard development is. Just entitling the land, which I did myself, PM the job, which I did myself, and then answer the phones and rent the storage units once it's open. So learned the whole business as a team of one. And then we hired a construction project manager to help us with what we thought was going to be the second and third buildings that never came to fruition because the county shut us down on zoning meetings. And then 2 years later, in late 2018, we started bought our first building, and man, I wish I would have done that from the beginning, because we would have grown much, much faster. But I can't complain at all, because that first deal, they say one deal can change your life, and that one deal changed my whole life.
Yeah. And it is crazy, especially on the commercial side, how really it just does take one deal to completely change what you're capable of or the trajectory of your career. And so for everybody listening, that one deal is just around the corner. Just keep going out there, getting it done.
Yep.
So like you said, you like buying more than you like developing. Developing gives you gray hairs, buying a little bit easier. So tell us, from that development deal, you guys got it, you got it finished, you started leasing, and then you turned your eyes towards purchasing.
We bought
transition.
Yeah, we bought, 2 years after we built the building in 2019, it was worth almost $6 million. And we did a refinance. A lot of our investors stayed in, spit out a lot of cash to them and us. Me and my partner had 7 figures to go, put his down payments on what ended up being 4 more storage facilities, a $650,000 deal in Erie, Pennsylvania, $450K deal in Pittsburgh, a little deal. Number 3 was in Ohio. So yeah, little deals. And then 2020, we had the opportunity to buy a pretty big portfolio in an upstate New York market, raised $7 million. So yeah, it kind of got accelerated. And then, we built out our PE division where we have our acquisitions team and our cold callers and our underwriters and our finance folks. And then all the way over to property management where we have our, customer service, sales, collections, property management team. We're managing 200 plus vendors across our 65 properties now. So yeah, it kind of built a life of its own by 2023.
Nice. There's a lot of ways, since I do have experience in storage, there's a lot of questions that kind of come up and directions that we can take this. I'm going to give you a kind of an outline. I've been taking notes while you're talking. So I'm going to give you a kind of an outline of where I want to take this conversation. And then
how about, what if I just tell you like how it's changed, how the landscape has changed? 2021, interest rates were 4% on commercial loans, and you could find 8 cap storage facilities that were 99% occupancy that hadn't raised their rent in 5 years. You could find that. And we went and found a lot of it.
Very nice.
Yeah, we went and found a lot of those and bought a lot of those. Since then, interest rates have went from 4% to 7.5% on commercial loans that are outside of multifamily where there's a little bit of subsidy. And self-storage development went nuts. They built, everybody and anybody built a massive amount of self-storage.
Yeah.
Small towns, big towns, you name it, a ton of construction. And interest rates went up and housing transaction volume went down. So the demand for storage actually dropped, like move-ins year over year. 2022 was the high, 2023 was a little lower, 2024 was a little lower, 2025 was a little lower. While interest rates double, it's sheer chaos in the business today. Gabe, I'm not gonna lie to you.
Yeah, that's what I've been experiencing too. So let's talk about specifically your acquisition strategy. And I guess I'm kind of coming from a perspective of deals that I don't like, and I'm curious what your perspective on them is. I've purchased a number of rural deals, and then a number of deals that are literally in the city center, like downtown city center. They're still drive up, but they're downtown. And when I buy those city center deals, I just get destroyed by property crime, people breaking in, people trying to live in the units, all that kind of stuff. And I've kind of realized that I enjoy buying the deals that are way out in the middle of nowhere. And there's not a ton of, the NRSF per capita is kind of low. But the farmers can throw a building on their property for $30 a foot all in. Yes, exactly. And that's what I've kind of realized is like the rural deals, there might not be a lot of competition right now, but somebody can throw another one up for nothing.
It's some of our rural deals are doing really well, and some of our rural deals have gotten demolished because somebody just keeps building. They built 30, 40,000 square feet of storage in a town of 5,000 people. Yeah. So I think my acquisition strategy has been find yield. So we bought some in the city centers, we bought some in Florida, we bought some in Mississippi, we bought some in Indiana, Illinois, all the way up to Connecticut and New York. Our best performing deals are in areas where development's hard, Northeast.
Okay. Washington.
All the money flew to the South. Yeah. Everybody was after yield. Developers went nuts in the South, even in small towns like LJ, Georgia, Milledgeville, Georgia, Pensacola, Florida has just gotten hammered by development. We bought a $1.5 million deal in Pensacola, Florida, luckily with only about $800K of debt, very luckily, because right across the street, Public Storage bought a facility and built a 50,000 square foot climate controlled building right across the street. And they rented 10 by 10s for $19 right after they built it. So, look, man, I haven't bought a single deal in 2 years, except small properties that are already on or near one of our current portfolios. That's a lie. 3 months ago, we closed on a deal in Kokomo, Indiana, a pretty big deal. I think we raised over $3 million. So yeah, there's yield few and far between, but I mean, now from an acquisition standpoint, we are underwriting a ton of deals every single week. All of them are at 60, 70, 75% occupancy. All of them have declining revenue year over year.
Mm.
For the first time in the history of self-storage, all the REITs, all the real estate investment trusts reported declining NOI 6 quarters in a row.
No way.
6 quarters in a row. Public Storage, Extra Space, CubeSmart, all of them declining net operating income 6 quarters in a row.
Huh.
So you tell me, like we bought a ton of buildings on floating rate debt in 2020, 2021. I'm blessed and very lucky to say that we were wise when we acquired, and we got through every single refinance without any cash in from our investors.
That's good.
Yeah. And we're not going to lose any of our buildings, but I'll tell you, half of them are below projections.
Yeah.
Luckily, all but one of our properties are actually sending cash to our investors, but not at the level we'd hoped on half of them, like I said. So if anybody's hoping that this was going to be a big pump up session on how to get into self-storage and why self-storage is a beautiful business, I think coming out of this self-storage recession that we've been in for the past 2 years, and I think may continue for another 2 years, there will be massive opportunity, of course, because prices are already starting to reset. People are getting out of the game. Many of the people who came in and bought 1-2 properties are trying to offload them and get out of the self-storage business. I don't blame them. Yeah, madness, my man.
Hey, man. But that is what happens in any asset class that gets as pumped as self-storage was. I mean, there was a lot of hype around it, and people got really excited about it. And so, it's going to be inflated, but that type of stuff always resets. You're going to have the up, and then there's going to be the downside to that as well, where people stop building self-storage. They stop adding, square footage to every property or every metro out there. And then things start to stabilize a little bit. So
our plan all along was buy a building that's under managed. Like they hadn't done the work to really drive leasing, really have digital marketing, have a good sales team that answers the phone, have a clean property, and then raise rents, like do standard revenue management inside the business. So that's generally worked for us. We bought a lot of properties that were full. We bought them, we cleaned them up, we raised rents, we brought in technology, we started digital marketing, we take a really leasing forward approach. On average, across our portfolio, we've raised rents 40% since acquisition, raised revenue.
Yeah.
Revenue has increased on an asset that we bought on average 40% since we acquired it. But it's just a boring time in the business right now. We're fine tuning on our digital marketing, on our sales approach, on our revenue management. We're working on a lot of things inside the company, kind of waiting for the ball to drop on the acquisitions and kind of what we think will be a pretty busy couple of years once it opens back up.
Nice. So yeah, let's talk about lease up. So I do Google Ads now. I started out doing storable and that kind of stuff, but they just charge you out the ass for that for their
3 months rent now.
And so I'm focusing 100% on Google Ads. What are you guys doing? Like, what's your lease up strategy?
Yeah, a lot of Google Ads. We do meta retargeting. We have a full-time digital marketer from South Africa on our team, and a web developer as well on our team. So we're tracking transitions. We actually track website visitors. We retarget them across, our sales outreach campaigns within 5 minutes of when they leave our site. Google Ads, meta retargeting, and then a lot of focus on SEO and Google reviews. For all the self-storage operators listening out there, we have a South African sales team, which I highly recommend over the Philippines because it's just so much more approachable accent for US consumers. We've seen conversion rates on a inbound phone call go up from 30% to 42% on our inbound leasing team by switching from South Africa to, switching from the Philippines to South Africa. We also hired a head of sales. We also really got the talk script down. We really, got the upsells and downsells and like discounting down on the phone to like secure a lease. So like we got very serious about renting units on the phone. Like if you get a call, we're listening to your call. We're training our reps. We're like going through a very sales oriented approach to lease a storage unit. That's helped a ton, but it's still slow. Like we were looking at data today. October and November are pacing actually higher than last year and the year before as far as total rental inbound. But the summer, June, July, and August was the slowest summer in 3 years for storage rentals.
Wow, that's interesting. That's funny because that's also been the case with my properties too. I know that, we expected a really huge lease up season and it didn't really happen. We had a bit of lease up, but not as much as we expected. And we're just like, interesting. I wonder what happens.
It's overall market softness that we just got to weather. We got to weather the storm until the next bull market.
Yeah, makes sense.
Yeah.
And it's interesting that you said South Africa. I've also switched from the Philippines. Actually, I went to Egypt, and so I've been hiring
Cool.
people out of Egypt. They have similar accents, and so we've had some success with there. And I've heard people say a lot of good things about South Africa and also Belize. I don't know why Belize. I haven't hired people from there.
Have you hired any finance in Egypt? Egypt, one of our analysts and underwriters is Egyptian and phenomenal on Power BI and Excel, and helping us with our underwriting is just unbelievable. Nice. It's a finance hub.
Yeah, I did not know that. The person, we hire callers and mostly callers out of Egypt. But yeah, that's a good point for the finance part.
One thing that we do is we put all of our sales reps on a variable comp plan. So when they rent a unit, every rental that they make, they get either $10 or $20. They start at 10, and if after they get 30 rentals in a month per rep, everything jumps to 20. All of it jumps to 20. So they're very, very motivated to make sales. And we also motivate them by, it's $2 and $4 for a rental, and a Google review is $10 per Google review. So at the end of every conversation with a tenant, they say, "Hey, Gabe, thanks for renting with Bolt Storage. I have a internal competition going on, by the way. And if I get a review with mentioning my name, I get a tip of $10 from my team. I get a $10, bonus. And if you leave a Google review with a photo of our facility, I get a $20 bonus." And we give that directly to our reps. So it's in our talk track where every single interaction with a client, they're asking for a Google review. We got 110 5-star Google reviews last month.
Wow. Nicely done. Yeah. Google.
So you cannot pay or solicit reviews from clients, from customers with any kind of compensation, whether it's gift cards or payments or discounts or anything. It's illegal. It's against their terms, but you can motivate your team to solicit reviews.
Yeah. Yeah. Google reviews have a huge impact. In fact, we bought a facility and the Google reviews were like 3.4, 3.5, and we got it above 4. And just that, nothing really changed with the facility. We didn't do a huge facelift or anything like that, but just the Google reviews pumped them up a little bit. It makes a huge impact. So that does matter for sure. And I love that you guys do compensation or performance-based compensation. I'm a huge fan of that across the board. If somebody brings us a deal, we pay them. If somebody, does anything that positively affects the business, we try to associate that with the dollar amount, and so that there's incentive across the board for people to actually do things that matter. Move the dial, get those KPIs going up. And I like that you guys.
Yeah, I think any amazing business leader would agree that you just follow incentives, and that's how all businesses function. So why would you not incentivize certain behavior?
Yep, absolutely. So I also noticed, I took a peek at the clock. We're running down the time, but I want to talk about industrial, because you mentioned, I don't know if you mentioned at the beginning of this recording, but you guys have bought industrial. Is that something that you're kind of pointing your attention to as well? Or why'd you guys buy those ones?
They kind of fell into our lap here in our local market. Industrial is a really funny thing. Like self-storage, one of the reasons why self-storage is getting tough, in my opinion, is that you give us a pen and a napkin in 10 minutes, we can come up with a rough value of a self-storage facility anywhere in the country, especially if we know the rent roll. But you can give me a Google map location, drop me a pin and give me 5 minutes, and I can tell you about what a storage facility is worth by measuring the building on Google. That's a massive disadvantage when you're competing with people all over the country to acquire assets. Industrial, totally different ballgame. Like, you really have to understand that local market. You got to really understand the building and the desirability of a building for a tenant. You got to understand the leasing market in a certain town. So we acquired 2 properties, one single tenant and one multi-tenant in Athens, Georgia, in our town. We rented one to a brewery. We're renting the other. It's kind of small bay, average 2,000 square feet per unit. So both those deals are going really well. Love the market, love the asset class. Very hard to scale. I wouldn't feel comfortable even buying a deal in Atlanta, for example. I live in Athens, an hour and a half from there. Definitely wouldn't want to buy a deal in DC or Philly or one of these small towns that we buy self-storage in. Yeah.
So the only reason that you guys kind of focused on that is it came, fell in your lap, and it was in a market that you already knew. And so it was just kind of a happenstance. It's not an actual strategy that you guys are trying to employ.
I would love to employ it long-term. And I think we're going to try to find a way to get comfortable with some other markets, but yeah, it's not something that we're not going to take the eye off the ball with storage, because we've kind of built a pretty big machine there.
Yeah, absolutely. I do. I like industrial. I haven't bought one yet, but I've been looking at them for on and off for like 2 years now.
Yeah.
Haven't pulled the trigger. I've had a number of them come across my desk, but yeah, I like the idea of it, and I like the niche it serves. But you're right, there's a lot to it, and there's a lot of specifics about the building itself that you need to understand, like clearance height and all that stuff, and what's actually needed in that location.
Parking, turnaround trucks, like loading docks, cold storage, ceiling heights, office ratio. There's a lot going on. It's not just a steel box that's 10 by whatever, and you lease it for $50 a month.
It's very easy to understand storage. It's just a door and some empty space that you need to know.
No toilets and bathrooms either.
Yeah, exactly. All right, man. Well, it is 20 minutes on the dot right now, so I got to push us into the quick question round. Are you ready?
Let's do it.
All right. Starts with education. It could be any form. I need 2 recommendations, one for general life wisdom and then one for real estate. And this could be a book, a conference you've been to, a mentorship program you've been a part of, anything like that. Oh, he's going on the bookshelf.
I wrote a book called The Sweaty Startup.
Nice.
It's probably half real estate, half operations, which I think people confuse those two. Like they're the same thing. Real estate is an operating company. You have to know how to lead, hire, lease, like sell, all those things. So yeah, that book would help folks quite a bit. It's called The Sweaty Startup. I'm also a member of a mentor group called Hampton. Sam Parr founded it.
Okay.
Phenomenal people in there, and highly recommend it.
It's just Hampton, HOMH.
Yeah, like the hotel. Yep.
Okay, cool. And then your book, I'm assuming they can go on Amazon, Sweaty Startup, and look for it.
Yep. The Sweaty Startup.
Perfect. All right. Next question is for your younger self. Let's go back to the Nick who was just thinking about developing that first deal back in, I can't remember the year you said, but back in the day. Go back to him, look him in the eye, give him one piece of advice moving forward.
I would say life is sales. When you're getting started in any new endeavor, especially real estate, you have to get people to trust you from all angles. People won't sell to you unless they trust you. Vendors won't do business with you unless they trust you. People won't come to work for you because you're not reputable. You haven't been making payroll for 20 years. You have a disadvantage in almost every area. And if you're not good at sales, selling yourself and your ideas, getting investor capital, finding deals to buy, building relationships with owners, all of it gets way, way harder.
Nice. That is good advice and something that has not been said. You know, we've been over 600 episodes now and kind of keep track of all the pieces of advice that people give. And that's one that has not been said yet on this on the show. So, and
it's not just real estate. Life is sales, man. Like you want to do anything in life, you got to sell people, whether it's your kid getting in the car this morning or your wife going to the restaurant you want to go to for dinner.
Yep. And sales is communication. So that is a super important part of, not only real estate, but also just life in general. Moving us on to the next question. This is about the U.S. There is a ton of opportunity out there. Give me the single metro you're most excited about investing in today.
Oh, gosh. It's a double-edged sword, man. The South is growing and the South has, a better government to do business in. But that in turn has attracted a ton of competition, a ton of capital. So you're way more likely to have development competition in the South. So I'm going to go with a dying town in the North called Elmira, Corning, Horseheads, New York.
Definitely the first time that's been mentioned on the show. So, right on.
No, I mean, there's negatives up there as well, like property tax assessment risk and declining population. So you're just way less likely to have a developer pop a 70,000 square foot property across the street.
Yeah, absolutely. That's funny because one of my I have underwriting criteria, and one of the ones that I absolutely will not back off of is a negative net migration. So if the population is going down, I just won't look at it.
That's 99% of investors, and it's a wise way to invest. I'm not saying that there's anything wrong with that at all, but the capital is all searching for deals in these growing markets.
Yeah, and that's what I was going to say is I feel like a lot of people do have that same criteria. So in those dying towns, there's really not a lot of competition. So it's a good point.
My main piece of advice right now is going to be stick in the game. Like in the real estate business right now, if you can ride out this storm, if you can find a way to make money and find a way to stay in the game for the next 3 to 5 years, there's going to be 1/5 the amount of people competing with you as there was in 2022.
Yep. Yeah. I've had a number of guys on the show who've, been doing it since the 80s, and they just talk about how real estate is cyclical, and you just have to, the bad times are going to come, you just have to stick through it and then ride the wave as it goes up. And that's,
my buddy says, he's an older gentleman, and he says, there's many times in the real estate business where you have to sit on your hands for years. So rule number one
that's hard.
Rule number one is never do these deals and find a way to have enough money to where you don't have to do deals to pay your bills. And number two, pick up golf.
That's funny. We've kind of taken a different approach. We started a second company. We're doing digital marketing for other companies now.
Yeah.
Digital marketing is something that I've been doing all my life, and we're pretty good at it. And so we're starting to market for other companies as a digital marketing company to kind of bide the time as we wait for the real estate market to tick back up.
Yep.
I'm like you. I haven't closed a self-storage deal. I haven't closed in probably over 2 years. We've been buying mobile home parks and RV parks. But yeah, it's definitely slowed down. There's not a ton of activity going on.
Yep. Yeah. And that's okay. You can make your business better.
Yep. Absolutely. All right. Next question is about finding deals. It all starts with getting in contact with the seller and penning that purchase agreement. So what is your favorite way to generate leads and find new deals?
We have a cold calling operation of South Africans that make, 400 combined phone calls a day across 3 reps or 2 reps.
Nice.
And I'm not the guy to ask because we've only bought one deal in the past 2 years.
Hey, that's okay.
Nothing's penciling, man. People want too much money right now. So we're in the relationship building game right now, trust building game. We are meeting owners. We are talking to them. We are making sure that we're front of radar. We are, operating our business well, and it'll come around when the buying opportunities open back up. Like, we are going to be ready. We're going to be capitalized, and we're going to have those relationships.
Hey guys, quick break from the show. If you've listened to this podcast before, you know we are always talking about how important it is to have the right mentors and partners in real estate, which is exactly why I've opened up the Real Estate Investing Club online community. It's a place for active investors to learn, collaborate, and get real deals done together. And right now, it is 100% free to join. We host weekly calls where we review deals, talk strategy, and share tactics. Just click the link in the description below and come join us. Yep. Yeah. Strategically positioning yourself for the opportunity is the wise thing to do for sure. Mm-hmm. It is hard though, because when you haven't closed a deal in a while, you start to get the itch, and you look at deals and you're like, man, can I make this work? But the second that thought pops into your head, you got to realize that's the wrong thought. Making something work that's not the way to go. It has to work. It has to work on paper, without any magic, any like mental jumps.
Yeah.
And so yeah, you gotta watch out for that. All right. Next question is about lessons learned. I'm sure you got a lot of these. Not every deal goes the way we expect it. In fact, pretty much every time something's going to go wrong. And that's when we get to learn a lesson. So what was a deal that went a little bit sideways for you? And then what was the lesson you pulled from it?
Actually, the best lesson I had was a deal I didn't do. My CFO is very wise, and he is amazing. He's very risk averse. I'm risk on. I'm very ambitious. He's ambitious as well, but he also is a little bit wiser with risk. He went on vacation for 2 weeks, and he was out of the office, and I put 2 deals under contract while he was gone. He gets back and he looks at the deals and the purchase prices, analyzes the deals, and he calls me and he's like, Nick, these deals are shit. We can't do these deals. And I'm like, whoa. Like, I'm the boss here, man. This is kind of what I want to say. But of course I didn't say that. Of course I was like, whoa, okay. Like, why do you think that? And, over the next day, he talked me out of it. And I'm the one who made the call to these brokers. They're the only 2 contracts we've dropped since we started. And we dropped the deals. And I think dropping those 2 deals saved us an insurmountable amount of stress and headache over the past 2 years, because we were indeed going to overpay.
Well, so what was the specifics about the deal? It was just the cap rate, or?
Yeah, I was just too ambitious with our lease up, too ambitious with our rent increases, and underestimating a little bit of expenses, like hitting it from a couple different angles to where, I thought it was going to stabilize at a 9 cap, and he knew it was going to stabilize at a 7.
Yeah.
And when you stabilize at a 7 cap and your interest expense is 7.5%, you have a negative, debt constant, and you're not making any money on your cash flow gets major hit. So our investors wouldn't have been thrilled.
Nice. Yeah. That is a bullet dodged right there.
Yeah.
All right. On the obverse of that, sometimes things go right and they kind of stick out in our mind as those special deals that we really enjoyed doing. So what was your highlight reel? Give me the single deal that is one of your favorites.
Yeah, it's got to be that first development that just changed everything for us. We built it from the ground up for 2.4, bought the building across the street for $500,000. So we're all in for 2.9 million on this deal. And it's worth $8 million today, doing over north of $100,000 a month of revenue. It's just incredible. So that one deal, I could have never done another real estate deal, and it would have kind of paid me a salary for the rest of my life, which is pretty unbelievable.
It's crazy. Yeah. No, that's awesome. All right. Next question is about raising money. It takes money to make money in real estate. So what is your favorite way to raise capital?
Yeah, I take a different approach. I think a lot of people who are raising capital, they come into these meetings and it's all the positives. This is why it's going to work. This is why we're amazing. This is why, our track record's unbelievable. This is why the market's great. This is why this town is perfect. This is why this deal is going to be a home run. I sat down with a lot of investors in 2022, 2023 and said, hey, look, this is a good deal. Like, I like this deal. I'm going to put some of my own capital into this deal, but you got to understand that there's some things out of our control in this deal. Interest rates, number one. Construction risk and development risk is number two, and storage demand is number three. Like, I can't impact how many, I can only have so much influence on how much our phone is going to ring people that want storage. I don't have any influence on who builds across the street or down around the corner. And then there's interest rates, which, if we could predict that, we'd be rich. So we wouldn't be in this business anyway. So those three things take a swing in the wrong way, and our 5-year time horizon becomes a 10-year time horizon. I'm committed to you that I'm not going to lose this deal. We're not going to lose this property, but we could be riding out a slow real estate market for years. Are you okay with that? What makes you want to invest in storage? And when I shut up and, they either run away and scared with their tail between their legs, and that's good because they're not a great fit for real estate in general, or they kind of appreciate that I'm worried about those risks and I'm thinking about them and I'm real. And, it's worked really well to me to kind of manage and set expectations with investors and show them that I am worried about the things I should be worried about and how to mitigate those risks.
Yeah. Yeah. And on that, I will say, if anybody only talks about the positives, then just run away. It's not a good deal.
If it sounds too good to be true, it likely is.
Yep, exactly. All right. And this is the second to last question. And this one we actually just recently added to the list of questions that we ask, but I like to ask because I'm super big on AI. I'm trying to implement it in as many, responsible places as I can in my business. So, do you guys use AI as part of your tech stack, and what ways are you using it to the most advantage to your business?
Yeah, we have a lot. We use it a lot for quality control. It's in the inboxes and it's listening to all of the phones of my people. Zapier is in my email inboxes, connect to Gmail, and I can get negative client sentiment across all my companies delivered to me and my management team. That's phenomenally valuable. I love Fathom. And again, the Zapier API is really good for AI. I'm a bear though. I don't like AI. I think the bubble is going to bust, and I don't think it's going to keep advancing as people think it is. The energy use is just phenomenally out of whack. It's being subsidized from every level of the chain, and the bubble is unfortunately going to pop, in my opinion, on AI.
I'm kind of on the fence about that one, and I'm not. I'm curious about that sentiment because people say the bubble is going to burst. I think it's
like the internet. I think long term it is going to be an unbelievable change. Like, everything is going to be different because of AI. I'm not doubting the long term value of AI. I just think the near term, all these companies using all this energy. I think the data coming out of these companies like OpenAI and X, they're drastically under reporting how much energy they're actually using. It's not sustainable, and it's going to get really expensive, and then only a certain amount of people are going to be able to use ChatGPT. It's not like every person with $29 a month is going to be able to ask ChatGPT questions all day about how to cook or how to think about a historic event. It's just not realistic.
Interesting. So you're really coming at it from an energy use perspective.
Yeah.
I don't know enough about
my energy bill in Athens has went up 6 times since 2023. It's up 60%.
Wow.
Long term, I fear that AI is going to separate the people with serious money who are going to use AI and everybody else is going to have a lower quality of life because they're not going to be able to run things like their heater, their air conditioning, their dishwasher, the things that actually make their lives better. Because there's 17 data centers under construction right now in Georgia. They've all negotiated power that's unsustainable. They've all negotiated power deals with local municipalities that are not sustainable.
Huh.
So like, what
the
gives?
solution is things like nuclear energy, or
it is, but we're 30. If we started right now on a full all-out billions of dollars energy sprint to build nuclear, it would take 30 years to get the first plant up and operational.
Damn, that's crazy.
Yeah, big problems.
This could be a whole other podcast. I got a lot of thoughts about that one, but we're closing in on 35 minutes here, so I'm going to shut it down and lead us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a two-parter. Where can they find you, and then what can they expect when they reach out?
I check my email, nick@sweatystartup.com. Me, my executive assistant, and my head of media are in there reading every single message. Can't guarantee that I'll respond to every single one, but if you want to get in touch with me, I have a social media presence on X @SweatyStartup, Instagram @SweatyStartup. And I got a podcast on real estate, podcast on small business. And then the best way to get a look into my story and my mind is my book, The Sweaty Startup, which I read the audiobook, and it's a good way to get in touch.
You read it. That's awesome. You read the audiobook. That's pretty cool. All right. I will put those links in the show notes. So if y'all want to reach out to Nick, all you got to do is click the little more in the description. It's going to pull down that full description, and in there you can find his links. All right, man, that wraps it up. Thank you very much for hopping on the show.
Thanks for having me.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe, at therealestateinvestingclub.com. If you guys want to support the show, just leave us a review or a comment or anything like that. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.